Today we're diving into A Random Walk Down Wall Street by Burton G. Malkiel, a classic that's been guiding investors for over 50 years. Whether you're new to investing or a seasoned pro, this book's insights on markets, bubbles, and smart strategies are pure gold. This is my personal summary and analysis for educational purposes only. All rights belong to Burton G. Malkiel and his publishers. Trust me, my summary skips a lot of the juicy details and data. Grab the full book on Amazon or your local bookstore to dig deeper. It's a game changer for navigating today's wild markets in 2025. First published in 1973 and updated through its 12th edition, 2020. A Random Walk Down Wall Street is a cornerstone of investment literature. Burton G. Malkiel, a Princeton economist, argues that markets are largely unpredictable, random, and challenges the idea that anyone can consistently beat them. With humor, data, and clear prose, he demystifies Wall Street for everyday investors. Malkiel's credentials: professor, former Vanguard board member, and advisor to wealth managers, make his insights credible. The book blends theory, history, and practical advice, selling over 1.5 million copies and influencing legends like Warren Buffett. It's perfect for 2025, with markets swinging from AI hype to crypto crashes. Key ideas in A Random Walk Down Wall Street. Here's a high-level, paraphrase summary of the book's core ideas, sticking to the main concepts without reproducing long excerpts per fair use guidelines. The random walk hypothesis. Malkiel's central thesis is that stock prices move randomly, following no predictable pattern. He introduces the efficient market hypothesis, EMH, which says prices reflect all available information, making it tough to outperform the market consistently. He compares picking stocks to a drunkard's walk, unpredictable and erratic. Short-term price moves are like coin flips. You can't reliably guess the next step. Fundamental versus technical analysis, a reality check. Malkiel breaks down two common investing approaches. Fundamental analysis, studying a company's financials, earnings, revenue, etc., to pick undervalued stocks. He argues it's flawed because markets quickly price in public data, leaving little edge for amateurs. Technical analysis, using charts and patterns, e.g., head and shoulders, to predict prices. Malkiel calls this near futile, as historical patterns don't reliably predict future moves. He backs this with studies showing most analysts underperform a simple market index. Market bubbles and investor psychology. The book dives into historical bubbles like the 17th century Tulip Mania, the 1929 crash, and the 2000 dot-com bubble, to show how greed and herd behavior drive irrational price surges. Malkiel explains how investors get swept up in new era hype, only to crash when reality hits. He warns against chasing fads, emphasizing that no asset is immune to overvaluation. The case for index funds. Malkiel's biggest takeaway is to embrace low-cost index funds. Since beating the market is so hard, even pros struggle. Buying a broad market index, like the S&P 500, gives you average returns with minimal fees. He shows data proving index funds outperform most actively managed funds over time, thanks to lower costs and diversification. It's a simple, boring strategy, but it works. Practical investing tips. Malkiel offers a roadmap for everyday investors. Diversify. Spread your money across stocks, bonds, and other assets to reduce risk. Dollar cost averaging. Invest a fixed amount regularly to avoid timing the market. Focus on the long term. Ignore short-term noise. Markets grow over decades. Minimize fees. High fees eat returns, so stick to low-cost funds. For example, Vanguards. He also covers asset allocation, suggesting younger investors lean heavier on stocks, while older ones add bonds for stability. Modern markets and updates. Later editions address newer trends like ETFs, smart beta funds, and behavioral finance. Malkiel acknowledges that markets aren't perfectly efficient. Emotions and mispricings create opportunities, but argues most investors are better off sticking with index funds than chasing these edges. He also critiques hot trends like pre-2020 tech bubbles, urging skepticism of can't-miss investments. My analysis and opinions. This book is a 10 out of 10 for clarity and timelessness. It's like a wise mentor cutting through Wall Street's noise. In 2025, with crypto volatility and AI stock mania, Malkiel's warnings about bubbles feel spot on. His push for index funds resonates even more now. For example, during the 2024 market dip, S&P 500 index funds recovered faster than many active funds betting on single sectors. My critique: the book can feel academic, with dense stats that might overwhelm beginners. Also, while Malkiel downplays active investing, I think disciplined investors, like Buffett, can outperform with enough skill. Just not most of us. Opinion: if you're starting out, follow his advice. Open a low-cost brokerage account, buy an S&P 500 ETF, and invest monthly. It's not sexy, but it's stress-free and effective. For pros, the book's a reminder to question your edge. Are you really smarter than the market? That's the core of A Random Walk Down Wall Street. It's a blueprint for investing with less stress and better odds. My summary skips Malkiel's charts, stories, and deeper dives into market history, so grab the book for the full experience. It'll change how you see investing. You can find it on Amazon or your local bookstore. Support the author and level up your game. If you found this helpful, like, subscribe, and comment. Have you tried index funds? Or are you a stock picker? Next, we'll tackle another classic. Thanks for watching.